I'm Simon Lack with SL Advisors. I'm going to talk about inflation, and I'm going to explain why energy stocks could be the best bet you make to protect you against inflation. The first thing is federal debt has been skyrocketing, and it was moving up through the great financial crisis 2008, and COVID has taken it to levels that really look unsustainable. And there's no end in sight. As you can see this chart rolling out, we're way ahead of where we were at the end of World War II, and by any measure, debt to GDP is moving to new, untested levels. Part of the reason this has happened is because of COVID. And although the Fed will blame supply problems for inflation, what seems very clear to us is that the government just pumped so much money into the economy that it really boosted consumption. And that's what you see in this chart here. But what makes it worse is that the Federal Reserve is monetizing part of the debt as well. And if you look at the Federal Reserve's balance sheet over the last 20 years or so, great financial crisis 2008, it increased, very slowly started to come down, and then once again reached new levels that we'd never seen before, over $8.5 trillion of debt held by the Federal Reserve, which means that that debt has been monetized. Now, at the same time, real yields have come down and are negative. And negative real yields really defy any sort of normal understanding of economics, but they represent very strong demand from return-insensitive buyers, from central banks, from sovereign wealth funds and big pension funds. And to the extent that America is a debtor nation, negative real yields are in our interest. Negative real yields are good. Negative real yields mean that there's less penalty to inflation because we have this wealth transfer, we have this subsidy that's going on from those return-insensitive buyers to the borrowers, which are essentially the US government and by extension, US taxpayers. And at the same time, there are issues with how the inflation numbers are calculated. And my favorite, and one of the most egregious, is in housing, where and we've written about this on our blog many times, but the government doesn't directly measure the cost of buying homes. The government calculates what is called owner's equivalent rent. They survey people, homeowners, to ask them what they think they could rent their house out for if they were going to rent it. And of course, most of us don't really know what we could rent our house for. So it's not really a fair question or a useful question to ask, but that's how they calculate housing, and it's around a third of the CPI and a little bit less of the PCE deflator that the Fed tends to focus on. But the Case-Shiller Housing Index, as you can see in this chart, has been running much hotter than owner's equivalent rent in the housing numbers. And the result is that the Fed's raising rates, and you can see this yield curve here from the Eurodollar futures market, which shows interest rate expectations still below where the Fed is telling you rates are going to be. When you look at the FOMC projections table, the Fed's looking to get rates up to around 2.5%. The market really isn't there yet. And one of the things I find extraordinary about this is that if it's true, if the rate cycle really does peak at around 2%, as suggested by Eurodollar futures, that means that the Fed will bring inflation back down without even getting short-term rates up to their target inflation rate, never mind the 4, 5, 6% type numbers that we've been seeing recently. And that, to me, seems implausible. We think that interest rates are going to move up faster than is implied by the Eurodollar futures curve. So that's the outlook for inflation. I think there's plenty for people to worry about. I think that inflation is unlikely to come back to 2% anytime soon. Most people think it will moderate in 2022, but getting back to the Fed's target seems a long way out. This is the most dovish Fed I think any of us have ever seen, certainly in living memory. So now let's turn to the energy sector. And the energy transition has been the dominant story for energy stocks for quite a few years now. And yet it's still important to remember that renewables, solar and wind, still represent a very small percentage of the energy that we consume in the United States. Renewables get an awful lot of press, an awful lot of coverage, but the big story in energy in America in the last decade has actually been natural gas versus coal. And almost all of our emissions reductions in the US have come about through using more natural gas and less coal. And that positive trend is something that has reversed recently, partly because administration policies to disincentivize new natural gas drilling have allowed the price of natural gas to go up. At the same time, when you take a step back and look globally, it's important to remember that emissions are generated, for the most part, not in the rich world, not in OECD countries, but in emerging economies, China, India, Indonesia, across South America. And so this is where the emission problems are going to be solved, is in these countries. And to take one example of the failure, frankly, of global policy to deal with climate change, look at China's commitments. This chart shows here China's CO2 emissions. China is about 28% of global CO2 emissions. They're planning to keep increasing at the same time as there's pressure on Western countries to reduce emissions. China's planning to increase emissions and then suddenly start them coming down in a straight line through 2060. And I would suggest to you that that's an implausible assumption, and I don't think that'll happen. Turning to pipeline stocks, which is what we specialize in, there's an unfolding really positive story here, because these companies are spending much less on growth projects, and at the same time their distributable cash flow, which is the cash flow from their operations, is increasing, and the gap between the two is driving very strong free cash flow. And this is one of the few sectors in the market that we believe remains cheap. And a great example of that is to compare the equity dividend yields and the bond yields on several of the biggest companies in the sector. And you can see that even though dividend yields increase and bond yields don't, and investors are nervous about the bond market, there's a huge discrepancy between the two. And we think that equities in this sector are very cheap and should be favored over bonds. And in fact, this is probably the cheapest sector that we can see. So we believe that inflation is going to continue to concern investors, that it's important to find ways to protect against it. We think that the energy sector, and especially the pipeline sector, is one of the best places to invest to protect your portfolio against erosion through inflation. I'm Simon Lack with SL Advisors.